After a couple of years of really hard times in the Australian property market, we've finally got the first interest rate reduction in the last couple of years. Now, we know there's still so much negative conversation, sentiment, and news articles coming out around the Australian property market at the moment. And that's coming off the back of some really difficult times with COVID and then the interest rate rising cycle we've just survived. But in this video, Simon and I wanted to bring a few different ideas to you as to why the Australian property market could go up in 2025.
Now, I got through those afternoon blues a little bit better the other day when we did find the news of the 25 basis point cut in the interest rates. Now, we've been expecting this for a long time, right? Looking at CBA, looking at SQM, looking at a lot of the different money markets. We have been expecting an interest rate reduction. We just didn't know when, but it's finally come. And I'm super keen to dive into some of the data as to what's expected through 2025 now that we are moving into an interest rate declining cycle. So kicking things off with SQM data, Lewis Christopher, the director there, does an incredible boom bust report at the end of every single year where he looks at all of the major capital cities and the national average against a bunch of different scenarios as to where property prices could go. Now, why I love this one so much is because they actually dive into a bunch of different scenarios looking at if this happens, then this may happen, or if that happens, then this may happen. So what's just happened is he's been able to rule out 3 of the 4 scenarios, which has left us with scenario 3 being the most likely scenario. Now, this scenario is based on interest rates declining in the March quarter. Obviously, it happened in the January quarter, and population to grow over 500,000, which we'll talk a little bit later in this video. Now, the expectation based on this scenario is for the national average to go up between 6% and 10% in 2025, with Perth, Brisbane, and Adelaide being the front runners. But in this scenario, every single capital city around the country is expected to increase in value this year, which is super exciting news for markets like Canberra, Melbourne, Hobart, and Darwin that have all been in a bit of a declining cycle of recent years. So breaking it down state by state, capital city by capital city, Perth is expected to go up between 15 to 20% based on this scenario. Brisbane expected to go up between 11 and 16% in 2025. So they are the 2 top performing markets according to SQM in 2025. Now, little old Darwin is expected to go up between 6 and 10% this year, coming off an underperforming market for the last decade. Now, something that gets me super excited is Melbourne, which looks like it is coming off the bottom of a declining cycle with the potential to go up between 2 to 6% this year. Now, Sydney is looking quite similar, between 3 to 7% growth. Adelaide hitting those double digits between 10 and 14%. Hobart going up between 1 and 5%, and then Canberra going up between 2 and 6%. So across the board, we're seeing capital growth rates based on this scenario throughout every single capital city, but obviously some winners and some losers there.
Now, obviously, there's some phenomenal projections according to SQM this year, and I hope, these guys don't have a crystal ball, but I hope they do come true. Now, I think it's important to dive into sort of why these expectations are so high, and there's a whole bunch of reasons which we'll start digging into now, including the history around interest rates and the declining phase of their cycle, population growth rates, and supply and demand in Australia. Now, if we start things off with the big news, which is interest rates, Simon and I have both come across some pretty interesting information over the last 5 years. Now, Simon just stumbled across something from CoreLogic where they looked at declining interest rates versus capital growth rates in Australia. And what Simon and CoreLogic found was that for every 1% drop in rates, we saw about a 6.1% lift in property prices over the next year. Now, about 6 or 7 years ago, I stumbled across some information from CBA Bank, and the history that they were presenting over a 30-year period was actually insane. So for every 1% drop in rates over that period of time, that was sustained for about a year to 2-year period, we saw about a corresponding jump in prices across Australia of over 15%, which is absolutely nuts. Now, whether it's 6.1% or 15%, it might be somewhere lower than that, in the middle, or even above that. But what I can say is that interest rates declining are a very, very positive leading indicator for future property price growth in Australia.
But it's not only interest rates that have an influence on property prices, it's also people. And Australia's importing a lot of people at the moment. So
importing, I love that.
I'll say that again. In fact, we're actually bringing in over 500,000 people in 2025, according to the ABS. But what's interesting, if we look over the next 5 years, the expectation is for that population growth rate to remain relatively high, being at about 470,000 people per annum every single year between 2025 and 2030. So why this matters is regardless of whether that person is coming over for school or for work or for other reasons, they've got to live somewhere. Now, a lot of the students will occupy the majority of the inner city apartments close to where the universities are in Brisbane, Sydney, and Melbourne. But a lot of these skilled workers are going to be either looking for a rental or looking to get into their own property as well. So this is expected to result in vacancy rates remaining relatively low, rents expecting to go up just slightly, and obviously property prices rising off the back of it as well.
Another key factor or a leading factor of where things could be heading in 2025 and beyond is this equation of supply and demand. Now, from my review of history, there's really only two markets. There is the chronically undersupplied market and the chronically oversupplied market. Now, it wasn't that long ago that we were talking about a massive oversupply of dwellings in Brisbane, Canberra, Sydney, and Melbourne. And while a couple of those markets still might be completely oversupplied from an inner city unit perspective, when we look at the outer and middle ring suburbs, that's where we're getting into massive supply issues in the likes of Brisbane, Sydney, and very soon to be Melbourne. Now, I think personally this has come off the back of COVID and the result of a heap of people moving here, but construction prices effectively doubling. Now, for most of the last 5 years, construction and building dwellings, because of the cost, the delays, and all of the bankruptcies in that space, has been a bad word or a dirty word in most people's mouths. What's that resulted in is a huge amount of people coming in and not enough dwellings being built each year. Now, whether you're looking at the total number of people coming in versus the number of dwellings, Michael Matusik's analysis, CBA's analysis, or even the Housing Industry Association of Australia's analysis, where we're moving towards is a monster undersupply in many of Australia's major metro markets, which is going to continue to put pressure on prices, rents, and the availability of the types of properties that we want to live in as Australians. Now, the result of this imbalance between supply and demand is generally in the past the same as interest rates. There's a very strong correlation between undersupply and meaningful property price growth in the short term.
Now, the next couple of things are pretty linked together, which is infrastructure and unemployment. Now, in Australia, there is a massive infrastructure boom occurring right now. There is hundreds of billions of dollars being spent of projects underway and in the pipeline. And all you got to do is drive through Brisbane, Sydney, or Melbourne to just realize the absolute size of these incredible infrastructure projects. Now, these always need to come as that population grows, as the government gets access to more money, or part of the COVID bailout scheme, which is obviously one of the major reasons Australia is seeing this infrastructure boom. But then that also creates good jobs. You know, those projects need people to bring them to light. So what we're seeing is unemployment rate hover around the 4% mark at the moment, could potentially get to 4.5% by the end of 2025. But what we're seeing is most unskilled workers are ending up in that unemployment category, whereas a lot of the highly skilled individuals are able to go out there and get a job that they want at the moment.
Now, one of my favorite little things to track each month is the ANZ Roy Morgan report, which effectively keeps a little bit of a finger on the pulse in terms of what's going on with how people are feeling about their future and the future of the economy and property prices. Now, historically, this number in terms of the good times, the bad times, and the average times over the last 50 years has sat at around about that 120 point mark. Now, what's interesting about the current market at the moment is although so many good things are happening, that washover effect from COVID and interest rate rises are really sort of making people feel a bit down and out. And that number is sitting well below the 100 point mark at the moment. Now, when we compare how people are feeling now versus the very start of COVID when we were all scared and all upset, or even the last GFC, we're only a few points above those markets at the moment, although things are so much better. And I think this is one of your key advantages as an investor or someone listening to this sort of content, is to get ahead of the curve and really start to feel good about where things are heading in 2025 before everyone else gets into it later in the year.
The term housing crisis has been used so much over the last few years, and let's be real, there is some issues with the housing market at the moment, but the reality is there's still some super affordable markets out there. So as long as you're not buying your own home in an area where you have to live, there's so much investment potential. And so many of our friends that have grown up in South Sydney have chosen this rent investment form of buying property because it allows them to still expose themselves to the market without being left behind. Now, when I talk about some of the more affordable capital cities like Brisbane, like Melbourne, like Darwin right now, you can buy a cracking townhouse in Brisbane for about $550,000, or an incredible investment grade property house on land within 30 k's from the CBD for just $700,000 right now. Up in Darwin, you could buy a house less than 10 k's from the CBD for roughly $500,000. But even compared to these areas, Melbourne seems to be even more affordable, where you can still buy an incredible townhouse that ticks every single one of the boxes for roughly $450,000, or you could get into a nice entry grade investment property for about $500,000, where you're getting a 3-bed, 1-bathroom house on a 600 square metre block of land around 40 kilometres from the Melbourne CBD. So all of these are within reach for a lot of Australians right now, especially if you are going to start investing.
You know, me, like many other Australians, sort of put Melbourne in that Sydney box, right? Because Melbourne within 10 k's of the city is bloody expensive, and the Mornington Peninsula is expensive and Geelong's expensive, but these middle ring suburbs, sort of 15 to 30 k's from the CBD, or even a little bit further than that, are just so affordable right now. And it wasn't until we went through and looked at over 500 suburbs in Melbourne versus 400 suburbs in Brisbane versus 600 suburbs in Sydney that we went, shit, the market is missing a monster opportunity down there, which is why we're so excited personally about the Brisbane and the Melbourne markets this year. Now, in terms of Phil Anderson's longer term real estate cycle, the 18.6 year cycle that we talk about often, the next phase that we're looking forward to after lavish government spending that we're seeing at the moment is easy credit or easier money. Now, to be honest, in Australia, since about 2016, when APRA stepped in and put all of those rules in place to make responsible lending standards in Australia, it's been bloody hard to get money. But what I've noticed is things are starting to ease up. So even though APRA might be suggesting that people put a 3, or maybe even, as Simon said off camera, a 2.5% buffer on top of the average interest rate, many banks are now in control of what they want to lend based on their own balance sheets at the moment. On top of this, we're seeing thousands or tens of thousands of self-managed super funds getting set up in Australia at the moment, and people buying property with those funds, where in the past the banks were asking for 30 or even 40% deposits in super. Now we're seeing a whole bunch of people getting 20% deposits, therefore being able to access their super, get some leverage on it, and get into the property market as a result. And we're also starting to see some new things that we'd always see at the later stages of a cycle, which may or may not be responsible lending in our opinions. I'm kind of thinking of The Big Short a little bit here when I'm talking about this, but in reality, there's a whole bunch of loopholes at the moment around trust structures, which many Australians are finding out from their accountants, their mortgage brokers, their financial advisors, where people are going out there and establishing trusts. And as long as the property is neutrally geared, then the banks are allowing people to continue to move forward. Now, 3-4 years ago, none of these things were possible. And all of that combined with interest rates coming down, people wanting to upgrade their houses, and all of these people coming overseas create the perfect storm for a much stronger 2025 than most people are going to realize, which is why, linking back to what SQM was thinking, incredible results ahead for this year if you know where to look.
And this is not to mention the tax cuts that were implemented in the last financial year, which haven't even been realised yet. People haven't even finalised their tax returns yet, so people don't even know how much extra they've been able to earn this year. So that's going to allow people access to more savings, access to more lending as well, which these literally went out to every single Australian. But then for the investors, there is incredible tax benefits as private investors in Australia. You know, you've got depreciation, negative gearing, which allows us to improve the cash flow on our investment properties as well. So absolutely love what we're seeing around Australia at the moment. There are so many reasons why we believe property prices could continue to rise, and it's looking like most capital cities are going to see a great 2025, and we'll have to wait and see what holds in 2026.
G'day guys, my name's Ben and I'm the director here at Pumped on Property, and I just wanted to say a massive thank you for watching our content today. Now, if you're thinking about buying an investment property in the next 3 to 12 months, then the team and I would love to offer you a one-on-one strategy session. In that session, we can talk about exactly where you are right now, where you'd like to be longer term, and we can deeply educate you on the Australian market. And then you can take that information and go and absolutely smash it on your own, or potentially become one of the small number of clients that we work with each week. To book your session, all you have to do is go to www.pumpedonproperty.com and click that book your free strategy session button. But either way, we wish you all the best on your journey as an investor to financial freedom.